All right. Welcome, welcome. Wow, that was super fast. Normally it takes a longer time for people to connect. Maybe Zoom upgraded here. But it's Mark Yusko from Chapel Hill, North Carolina, saying welcome on this beautiful fall day down here. Hopefully it's beautiful where you all are as well. I'm going to be mostly comic relief and the silent partner today because we have an amazing special guest who has so much to share on this incredibly important topic around AI. And Corey's going to be our MC for the engagement. So with that, I'll just say thank you for taking an hour out of your day here on Thursday to learn more about AI in the future. And Corey, take it away.
Well, thanks, Mark, and thank everyone for joining us today. And it's really just amazing how these webinars and just investment opportunities in general come together. Will Graves and Boardman Bay, it's been a firm that we've known about for probably over a decade at this point. I believe Boardman Bay started in 2012, and at that time I was connected with Will and Boardman Bay, and I just ended up on their distribution list. And I was watching from afar for many years. As we all know, the tech investment landscape is crowded and competitive, and Morgan Creek has already always embraced it as a theme. So we've always had a lot of athletes in that theme in our portfolios. So it's really a challenge to fire one manager, hire a new one, but we're always looking for, the next, top athlete within the arena, within the game. And, it's amazing how these things come about because, I was on the distribution list for about a decade. And then, a couple months ago, Will started talking about something that we were also working on that led to some engagement. And the deeper I dug, the more excited I got about, potentially doing some work together, collaborating on some projects, one of those projects now being this webinar. So, very excited to finally, after all these years, engage with Will, engage with Boardman Bay. And, it really is, great how in this business, it's all about the people, and, great ideas have a way of bringing, folks together, like us today. And, it's also, funny how, um, you may have a relationship or a partnership with someone, that works out, people move on, then you come back together. And actually before, Will was at Boardman Bay, he was at a firm that some people might recall called Stark Investments, which Morgan Creek actually had a relationship with at the beginning. Mark can correct me if I'm wrong, but I believe Mark, had some um, uh, exposure to Stark, back at his UNC days as well.
Yep.
So we've really gone full circle here, over the past 2 decades. And I think that should give you, some idea of Will's experience in the space. He's been focusing on technology the entire time. But it's really great to, come back into, um, touch with Will, have this conversation. So without further ado, I'd really like to just turn it over to Will to kind of fill in those blanks, tell us a little bit more, about Boardman Bay, more about his background specifically, and then we'll go from there. So Will, why don't you take us away?
Sure. Thank you guys very much. It's great to be working on this project together. As we've discussed, we've known each other or known of each other for quite some time. And that's something that we've realized continually within this industry. I mean, we've been in the investment space for over 20 years and around technology for a lot longer than that. And it always comes back to the relationships. It always comes back to the people that you know. And that's something that we really leverage, both in the two spheres that we really operate in, one, investment management, and two, technology. Having come from technology and being an operator, we really do leverage those relationships. So what's old is new again. So again, thanks to you guys for highlighting Boardman Bay. I can see that you pulled up a slide there. Corey, I'm happy to answer any questions about my background.
Yeah, maybe
it
to
is unique.
direct you,
It is.
Will. I mean, for
Well,
folks that
let me
are,
Sure.
just preempt. So before you get into the real background, I always ask one question, Will. I
Sure.
like to know like where people are from, like literally like where'd you grow up? And the question I ask is, what was your thing growing up?
Sure. Great question. So funny enough, I was born to two Manhattanites in New York City. But at the ripe age of 2, they decided that I should grow up in the American Midwest. And I grew up in Milwaukee, Wisconsin, on the shores of Lake Michigan. And I am forever grateful for that opportunity. My thing growing up was I found an early love for the sport of sailboat racing. And
Nice.
Being on Lake Michigan, freshwater, it was exceptional.
Love that. Awesome. I love the competitive side of it, and we could go off all day. All right. So Corey, your lead.
No, I was going to ask the exact same question, Mark, and pulling that thread a little bit farther. I mean, Will, why don't you? I tried to Google it. I wasn't able to find like a conclusive answer, but educate us
Sure.
all. Where does the name Boardman Bay come from? I'm guessing it comes from your Lake Michigan sailing days, but enlighten us.
Yes, funny enough, I think there's actually a name generator out there somewhere for hedge funds, and it's usually, A plus B is some sort of physical thing, like a rock, a bay, a sound, whatever. But using that same parlance, Boardman is actually my middle name, and it's my father's middle name. And my father's law firm, after he passed, they built a memorial to him that overlooks a bay to the north of Milwaukee. And there's a memorial that says Boardman in sort of arcing letters. And so we borrowed that, and that's where Boardman Bay came from.
Okay, that's great. And I'm sitting here just north of Chicago, about half a mile away from Lake Michigan. So we're connected in more ways than one. But this is
Absolutely.
fantastic. So maybe dig a little bit deeper. I mean, you studied at Penn, you're in the Navy, found your way into technology, sold a company, the Sun Microsystems, all before you really started your investing career. So just weave all that together for us today.
Sure. So from the shores of Lake Michigan, I went to the United States Naval Academy, and I went there because, it truly was fascinated in technology, and also, wanted to serve my country too. But if you recall that period, movies like The Hunt for Red October and all the Tom Clancy books, Red Storm Rising, they were all about using technology and these vast sensors that the government had. And that really attracted me. I thought that was something entirely different. Wanted to do something that was engineering focused, and the Naval Academy made a lot of sense for that. And also, coming out of the Naval Academy, I knew that I would serve and, have an opportunity to really, lead people early on. The division officer comes out of the Naval Academy, and I think the smallest staff that you'll see is about 25 to 30 people. And so, I really wanted those challenges. And so I went off to the Navy and had a great experience. I was a surface warfare officer, drove ships. I was an engineering officer on ships, primarily on the U.S. West Coast, Japan, and just a tremendous opportunity. I really got to, absolutely see that there's, I had immediately a team of 30 plus people who worked in an engineering department, and we were responsible for all the mechanical and electrical equipment on the ship. And, you learn a lot from your senior enlisted people. And it's one of those things I've taken away, is that you can learn something from everybody, and you really need to rely on teams like that. But at the end of the Reagan buildup, shifting into the Bill Clinton years, the Navy shrunk massively, and I didn't see the opportunities that I thought I would see. And so I went off to Penn for business school, got an MBA from Wharton. And from there, immediately, the focus was on the marriage of investing and technology. I actually have a unique major that I constructed there. It was high technology marketing and private equity. And from Wharton, went right to Silicon Valley. And the thing that I noticed first and foremost, believe it or not, this was at the height of the 1999, 2000 tech boom, was that I wanted to focus on enterprise technologies. I worked at a small startup that actually went public when I was there on an internship. company called Quokka Sports, and I could see that the revenue models of some of these internet companies was just not there, and you were really working on eyeballs. So from that stage on, I really wanted to focus on technologies found within the enterprise. And so upon graduation, I joined a little company called TerraSpring, just backed by world-class venture capitalists, and was really focused on the data center. And believe it or not, way back then in 2000, I mean, this is 7 years before Amazon Web Services came out. There were small companies in Silicon Valley that were working on, taking the data center and disaggregating all the components and, making it something that as a utility model. And that is the way that technology has gone. You hear about these massive utilities, which AWS and Microsoft Azure and Google Compute. You can buy compute by the drip. And to extend the metaphor even further, and we use this term way back then, is that the data center is really a utility. And you're starting to see that just on the behemoth size of some of these data centers today. So, Constellation Energy is just as an important utility as to a Microsoft as people think about foundational utilities way back when. So,
I always love these conversations because you find so many other threads. So we were actually investors in Quokka. Actually, I'll call him a friend. Not a close friend, not a close buddy, but a friend. Steve Nelson was involved. So were you there before or after Steve?
the name sounds very familiar. I don't remember him firsthand, but I was there, during the summer of 1999. The company went public.
Yep. He came and took over like after the IPO. So you had already gone, but it's such a funny, to your point, that time, what it kind of led me down a similar path I think you're going to describe. And it's in a way how Michael Stark and I eventually connected on this idea of investing in the public markets and then feeding private investments. Same thing at Integral Capital.
Yeah, we're definitely going to circle back and spend a good bit of the conversation today, talking about the similarities and differences, between the current cycle and the late 90s. But maybe just, before we get there, fast forward a little bit, a really interesting fact about, Boardman Bay that I like is that you opened your office on the same day in New York City that Facebook went public. So obviously a very exciting time for a previous cycle, that being social and the shift from desktop to mobile. But you mentioned in one of your recent quarterly letters that you think that the investment landscape and environment today is even more exciting than that day when Facebook IPO'd. So maybe just talk about that time, and then talk about bringing it to today, the investment opportunity landscape at hand and why Boardman Bay is so excited about it.
Sure. Well, that data point that you mentioned, that Boardman Bay, opened offices in 2012, the same day Facebook did. That data point is an anchoring part for a lot of the things that we've done and we've talked about. The company I was talking about before, TerraSpring, we sold to Sun Microsystems. I then worked at Sun on that very Facebook campus. Believe it or not, Facebook took over the Sun campus and has built it into this massive, it's 40 blocks versus 6 when I was there. And so, that one piece of real estate that Meta now sits on, I've worked on, and, it's pretty amazing. So, 2012, you can think about, another, we were talking about social connections. And, there was the opportunity to really take all of this infrastructure that had been built in the 99 through 2003 period, in terms of networking and internet and fiber to the home. You were able to, build these new applications that were very bandwidth intensive, but, could start to use all of that infrastructure. And I mean, that's what really accelerated there was connections. And I mean, Facebook now addresses, well over 50% of the world's population. I think they're up to 4 billion DAUs. And, that's great. And, Facebook, public investors since then have made a ton of money. But people really had to understand that early on, the power of connectivity there. And to today's day and age, I think it's changed yet again. I mean, pretty much from the Facebook period, call it 2012 to 2022, let's call that, really the OpenAI moment, the ChatGPT moment. Believe it or not, a lot of investors are really focused on either, classic connections, Facebook, DAUs, daily active users, things like that, or software with recurring revenue models. And the thing that was really forgotten over that period is the original part of Silicon Valley, silicon. I mean, if you look at the number of VC investments in silicon during that period, it's sort of at historical lows. And, today, investors are rapidly refining the importance of silicon and connectivity. And it goes all the way back to my time in the first tech period, 99, 2000, where the people that I worked with at TerraSpring, they broke down a data center and they said, there's really only 3 parts to this big stool. 1 is compute, CPUs, GPUs, whatever. 2 is networking, and 3 is storage. And there is always a bottleneck problem somewhere there. And so that's where Boardman Bay has been really focused on, is identifying those bottlenecks in this rapidly exploding infrastructure. And we've been spending a lot of time in networking, optical, and related technologies. So, I think the world has changed. I think the themes have changed since the Meta IPO. But the crazy thing is that Meta and Facebook are now one of the largest consumers of AI infrastructure. And they're actually getting real defined value from it. And you can see that in their earnings reports, et cetera.
Yeah, well, so you just kind of hit on it there, but maybe just distill it down to, a couple bullet points in terms of, what is Boardman Bay's, and I'm sure you get this question all the time, but what would you define as Boardman Bay's edge in, what we all know is a very hyper-competitive technology investing space?
Sure. I'd say a few things. I mean, one is genuine industry immersion. I mean, we come from backgrounds where we've actually worked in tech. We have relationships in tech. And then, of course, we have the Wall Street side of things. We worked for big hedge funds. We worked for venture capitalist firms of various sizes. So, I mean, one of the things, we're always on the ground focused on industry immersion. I sit on the boards of a number of our private companies. On those private companies, next to some very advanced individuals in both private and public semiconductor companies that give us just tremendous insight that's unique and differentiated versus what, let's say the average analyst at a large long only or a pod hedge fund would see. And we lever that. So we're industry immersion. 2, I think, is genuine focus on subsectors. We don't try and cover all of technology at one point. One of the things I learned from the Stark Investments period is you should really focus on areas where there's, a defined theme, there's real return opportunity, and I mean greater than 30% type return opportunity. I mean large compounding opportunities. And so, Boardman Bay often is hyper focused, and we've done that. You can see that in some of our funds out there. I mean, we have a fund that's entirely dedicated to optical technologies. Probably the only one that you'll find on the planet. It's been doing this since 2018, and is basically the AI infrastructure fund. Long before people were chasing AI infrastructure, if you will. And so that hyper focus, that industry immersion. And, of course, we do all the, bottoms up research work. We believe in, Porter's 5 forces and things like that. And we put the company in the center and we test all around it. And that gives us a high degree of conviction. And then I think you'll see, a high return correlation to that conviction.
Mm-hmm. Yeah, no, it's almost like you've been, waiting for this moment in markets to come around for a couple of decades now, and now it's here in terms of your expertise and experience. You're focusing on, data centers before, data centers were popular and cool and part of the everyday lexicon. Um, you, um, like you said, are a lead investor and on the board of, some really amazing companies like Credo, Ire Labs, and Grok. And, I think we've talked about this before. And it's, quite remarkable to see, you so involved with these companies, on the boards of these companies, yet, be relatively lesser known than some of the, tech investing, heavyweights out there. So, maybe just double click on that a little bit more and just, explain to us and our listeners today, like why these companies want to work with, Boardman Bay, why they want to work with Will Graves, why they want you on their board versus, someone else.
Sure. Well, yeah, I think it's multifaceted, the answer. Again, we're immersed in the industry, so we're continually talking to public and private companies. Many of our private companies, it's a lot like, our relationship with Morgan Creek. I mean, you've known of us for a long time. We've invested in, we've, interviewed and had long discussions with private company CEOs like Jonathan Ross at Grok, way back to 2018, 2019, maybe 2 years before we made our first investment. And, again, that industry immersion, and when you actually speak to founders like that, I mean, they quickly realize, who actually knows the technology and who is there just because, it's an emerging theme or something like that. And I think my team in particular has really differentiated itself in being able to talk to founders and, people within companies and, show a true passion and foundational knowledge of the technology and what they're trying to do. And that gives us credibility with them. And then they're also willing to, help us understand a sector, and they become additive to our research process. And related to that, we've also had, a number of demonstrable examples where we have joined a company and we've really helped them out. I mean, there's a company in particular that we helped, that we actually made a private investment in it. And we noticed that they weren't hitting their industry benchmarks. And, somewhat of a venture capitalist's biggest fears is a company that's just not performing. And, we went into the company, we spoke with the team, we helped them engineer a bridge financing. We created and structured convertible note for our investors. And it ended up having a very dramatic return as, we also helped facilitate the sale of a company to a very large public one. And so, I mean, we bring a big toolkit and we bring demonstrated examples of this. We have dedicated public funds, but on the venture side, we really have done everything that a very seasoned venture firm would do. We've led deals. We've basically done workouts. We've gone through multiple exits. We've gone through the fundraising process and follow-on capital. I mean, we've done it all. And I think that founders and management teams are aware of that. And we do add value. I mean, just before this call, I was on the phone with bankers, exploring opportunities for some of our companies. And that's what management teams really want, is somebody who's going to help them out and brings a toolkit to the table.
Okay. Let's segue here and bring it to the here and now, and really talk about the current opportunity set and why you still think now is a good time to be deploying capital. And just to um, spur you a little bit in terms of the direction of the conversation, in one of your recent quarterly letters, you kind of likened AI to an industrial revolution measured by CapEx in the same category as railroads, electrification, and the internet. So obviously that's a big statement. I think a lot of other really smart people, investors, and CEOs espouse that view as well. But paint that picture for us. In terms of the opportunity you think's at hand in AI.
Sure. I think, in some of our conversations, we've talked about the phenomena of, signal versus noise. And, in our optical investments, we think about that as well. I mean, the great thing about optical technologies is they're more signal and less noise. But when you think about AI investing, there's a hell of a lot of noise out there. But the underlying thing that matters is the signal. And the signal is that, unlike previous periods, the internet and the networking boom that took place before that, this CapEx cycle is being consumed almost immediately. That, this incredible growth in GPUs and the need for model training and all of that, and these CapEx numbers that literally are touching $1 trillion within the next few years among the major hyperscalers. That's a lot of signal right there. And if you dive just a little bit deeper and you look at what, the big four hyperscalers have been able to do, they've not only increased their CapEx dramatically, but they've also increased their EBITDA profiles, their EBIT profiles, however cautious you want to get. Their AI investments have played out. And, so that signal absolutely has to be respected. And, alongside that signal, comes a number of other vectors. And that is something that we follow very closely. For instance, the rapid growth in GPUs and compute. There's a lag effect, but that gets into networking. And believe it or not, the networking goes exponential. For, every 1,000 GPUs you add, and the number of connections per GPU goes up quite a bit. And it is exponential. And that's one thing that we've been focused on. And, so while there may be a lot of noise in the AI sector, and there will be, moments like, the DeepSeek, kerfuffle, if you will, and market blip that it had earlier, and there will be broader sell-offs for sure. I mean, you just saw a data point, 2 or 3 days ago that, there's an internal study that Oracle wasn't, entirely profitable in their use of GPUs. And that creates volatility, which, the noise can increase, and it gives long-term investors opportunities to, get involved again. And so, I think our industry immersion and being closely focused to it, we can recognize, when the noise is dominating the signal and invest. But I think underlying, and we talk about in our investment letter about, how Microsoft has become so much more profitable in doing this. Meta, you can see the same. And I think you'll see that play out into, many other industries. And it's, not just white collar or knowledge workers that, may see job decay, but, I think it actually affects a number of blue collar and maintenance type laborers as well. So, I think at the end of the day, the signal just has to be respected versus the noise. And
that's a good point. And Will, in terms of, signal versus noise, I mean, you're kind of talking about the, financing side of the theme being AI, talking about how the financing is, being backed by, big balance sheets from, the hyperscalers, and that's likely to continue for the foreseeable future. And, how to focus on that signal versus some of the other noise in the marketplace. But what about on the adoption side? What signal are you looking at, as kind of confirmation that adoption's occurring at the rates needed and necessary to, support this CapEx and funding? And maybe if you could,
Sure.
Think about it across not only the consumer side, but the enterprise side and also the sovereign side of the equation.
Sure. Well, I think there's a number of new metrics that are emerging, as there always is, around these events. One, people talk about CapEx and, brute dollars that are being spent, and, that leads to, basically a GPU total. And then, some percentage of that GPU and compute spend, goes to an attach rate, which is, related for our case. We look at that attach rate for networking equipment and high-speed connectivity and things like that. So, we're monitoring that very closely. But and so, that's just a sort of a brute spending by these large hyperscalers. But then, some of the more nuanced areas that are emerging, and they're actually mind-boggling when people get involved with the numbers, because we're talking, numbers that start with the trillions and, have, 100% growth rates, quarterly. And one of those is around tokens. And, tokens are really the consumption engine of AI. And, so we develop these large models, and then, a question is asked to them or is queried to them, is inferenced to them, and they generate these massive token counts. And, that is one thing that we watch closely. And, some of the public companies, Microsoft, Grok is a private investment. They disclose some of that token growth. And you can see how AI is being consumed and how it is really up and to the right. I think other areas that we watch closely, and I think people, rightly question, but I mean, if you look at, the subscriber totals of things like ChatGPT, I mean, they're pretty dominant out there. But, when they start to talk about, hundreds and millions of users, and you can see that growing very rapidly, and then you can see, their monthly pricing there. I think that's great, but it also covers, some consternation. I mean, you can compute their revenue total, but you also know what their CapEx is on the back end. So, there has to be, the hope and the dream of future services that fill in that gap, more material product that is derivative to those applications. And so, I mean, those are a few of the things that we're really watching. But we also, you have to be a macro economist when you look at some of this too. And, that's something that we, that gives a little bit of cause of concern for us. I mean, I think CapEx as a percentage, in any subsector, CapEx dedicated to AI is now hitting, some of those thresholds that we did see in periods like the railroad, the internet. Believe it or not, it hits some of the home construction metrics that we saw in the 2005 housing bubble, where, believe it or not, people were spending money left and right in home construction to chase after the housing bubble. So it is an area to watch, that overall CapEx as a percentage of spending, but one has to be very careful and again come back to the signal versus noise of where we're going.
Yeah. And Will, how do you make sense of, obviously there's a lot of talk in the marketplace right now, a lot of bubble talk, recently, based on, recent deals from, NVIDIA investing in OpenAI, the deal OpenAI just did with AMD. How do you make sense of the, really at a high level, circular looking nature of these deals and, get comfortable with how this growth is being financed?
Sure. Well, I think it's far broader than just those two deals like that. I mean, you're seeing these large banking organizations, Macquarie, and others and Morgan Stanley, others that are financing in debt the growth of companies like CoreWeave and others. And I think there is reasonable reasons to be concerned about that. Not everybody is a hyperscaler or a Mag 7 company that has just massive cash flows. And so we do put that on our radar screen as something that we'll be looking for on the short side and short opportunities. But you also have to go into the devil of these details. In particularly like the AMD deal, it's entirely performance related. It's mostly warrants for future use of AMD product and revenue and stock targets for AMD, and I think that's ultimately very accretive. And it also shows you that the world is going to be heterogeneous, if you will. It's not going to be completely dominated by NVIDIA as it is today. So I think we have to look at each one of those deals separately and see what they're trying to get at. Again, signal versus noise. But the overt just large ownership investments, equity investments that NVIDIA has made. In the big scheme of things for NVIDIA, believe it or not, those aren't even that impactful. And they can do it, off a balance sheet rather than often of, their income statement. So, I think each one of them has to be looked at that way. But I do get the investor concern about it, and we share it as well.
Hey, let me ask one question, Will, about, we see all of these linear extrapolations of growth and in particular, build out of AI data centers using GPUs. And then the next stage is, oh my gosh, we're going to run out of power. So we have to build all these,
Yeah.
all this new power. And we've seen these charts over and over and over again over the decades. We were going to run out of oil, in the 90s because cars were using too much, and lo and behold, cars got more efficient, and some cars don't even use oil anymore. And we found a bunch of oil through technological innovation. And then Bitcoin mining was going to use all the electricity in the world at one point, according to the New York Times. So this is a long question, but the question I have is, GPUs actually weren't designed to do what they're doing now. This brute forcing of analysis is very energy inefficient. It's why OpenAI hemorrhages cash, right? They lose billions of dollars every year. They're forecast over the next 4 years to lose 115 billion dollars of actual cash. So doesn't it make more sense that someone will innovate in chip technology or, power usage, like in-memory compute, or, like you said, optics instead of, 2 nanometer scale silicon? It all doesn't make sense to me that we're just going to keep doing this brute force, incredibly inefficient, not good for the environment. And by the way, everybody's power bill just doubled in the last 2+ years. Anyway, long question.
Sure. It's really funny. I was part of a stock picking contest that takes place every year, and it's, call it 50 well-known portfolio managers on the tech side. And last year's loser gets to make the first pick of the year. And the name that everybody was fighting over was Constellation Energy. And to hear tech portfolio managers arguing, utility scale power companies is really interesting. But it does show you how much the power and bandwidth for future growth is required. And, there are all sorts of data points out there that, to get to OpenAI's growth profile in terms of GPUs, you are going to need, massive amounts of power. And it's true. And so, that's one of our big sub-themes, is looking for technologies that are more efficient from a number of areas, whether it be speed and throughput and bandwidth and latency. Those are all great. But, the thing that most semiconductor purchasers and buyers, at a hyperscaler, what they really care about is the power envelope and how much it will tax their overall power. So, companies that we invest in on the private side, IR Labs, a leading company in photonics for co-packaging, their power envelope, it dramatically reduces what is used in electrical or classic wire cabling, and so the power area is something that's going to continue to be important, not only at the semiconductor level, but the components all around it. And to not to change the topic, but from a geopolitical side, it matters a lot. China doesn't have the power limitations on the grid that the United States does. And they can grow their data centers faster, more efficiently, and because they have higher use of renewables and all sorts of things. And the U.S. does need to spend more on power and infrastructure. But from our point of view, I like the way that you packaged it. That we can invest in technologies which improve that power envelope, and some of them are really, really meaningful. The overall optical theme is a meaningful step change in the right direction for the way that an overall data center operates.
Yeah, no, to your point on that, one of my favorite stories recently is, great, NVIDIA has been a great stock, yada, yada, yada. And AMD now is catching up. And they're important, right? And GPUs are great at parallel processing. But and I wish I remember the name of the company because it'd be a better story, but there's a company that makes cables. Like when you build a data center, right, you install the CPUs and the GPUs because you still need CPUs to run the GPUs. And then you need all these cables to link them all together. And someone said, I could build you a cable that's like way faster. Like, I don't know if it's 1,000 times faster or 100 times faster. Again, better story if I remembered all the details. But that little company has gone up way more than the chip companies because if you can't cable everything together, it really doesn't matter, which I just thought was really interesting.
You're absolutely spot on. I know the company that you're speaking about because we were a private investor
Ah,
long before their IPO, and
glorious.
it's a company called Credo.
Yes,
Fantastic management
exactly.
team.
Yep.
And we've been speaking with them for many, many years. And what you're explaining is an active electrical cable, an AEC. And basically, they've just taken these cables and put semiconductors on both ends of them. And that does all sorts of things in managing the cable and making it more efficient, and also controlling power. There's all sorts of things. And the company went public in 2022, and nobody was really paying any attention. I mean, there was a bit of a really downdraft market in 22, post the
Yeah.
COVID euphoria and then the supply chain correction and all of that. And tech was really dismal. But we advised the management team the day before they went public. It was a Goldman-led deal, and they absolutely insisted on going public because they had employees to pay. And just a fantastic company and story. We invested at $4.99. The stock is trading around $150 today. And that's what it's all about. It's about connectivity. And so you have these GPUs that are, exploding in use within the data center. And the next leg of the stool that is out of balance is networking. And you've seen that in the results from Credo. And then another company went public, Astera Labs. And
Yes.
Astera Labs, has a $40 billion market capitalization. You think about, I mean, they're bigger than companies like Marvell. They have, tremendous growth in front of them. They're still growing nearly 100% year over year. And again, it's because those cables that you referred to, there's multiple phases to those. You've got active electric cables. You've got Ethernet. You've got InfiniBand, which, NVIDIA is very closely tied to. And in fact, NVIDIA's market dominance isn't just because of superiority in GPUs and even software. It's that they can network the whole package together leveraging a company that they bought a number of years ago called Mellanox. But what's up and to the right beyond that is optical connectivity at the interconnect level. And we've made an investment. We were actually the lead investor of a company called Ayar Labs, AYAR, which we believe, will be the Astera Labs or the Credo of the next 2 to 3 in the next 2 to 3 years.
It's an amazing story, and we're actually pretty close to the Mellanox story because we backed a team that spun out of Mellanox for a new business. But yeah, I think I have my numbers right that NVIDIA bought Mellanox for like $7 billion, And last quarter, they did like 60 billion of revenues or something, and 25-ish% of those revenues came from the Mellanox solution. So twice what they
That's
paid for
right.
in one quarter. I mean, incredible.
Yeah, and that's exactly right. And I mean, Jensen Huang has been out there saying, this is the greatest acquisition of all time. And he's totally right. It was a $6.9 billion acquisition, and it is responsible for a massive chunk of their growth. And, but it brings up an interesting thing that goes all the way back to my TerraSpring days, is the world eventually at the data center level wants heterogeneity. It's easier to change. Costs go down. And so you can't have a homogeneous solution of NVIDIA GPU, NVIDIA connectivity, NVIDIA storage, all of that. That works for a little while, but parts of it start to get broken apart. And there is probably a period within the next few, probably quarters, but definitely within the next 2 to 3 years, where you really start to see that inflection that there are superior networking technologies that can integrate and operate around NVIDIA, particularly in the optical space. And it may, in fact, erode some of NVIDIA's long-term dominance. And that's that heterogeneity versus, one shop that does everything, which, basically doesn't work in tech for long periods of times. I mean, undue profits do bring in competitors. That's just a little law of the jungle.
Oh, absolutely. Well, and innovation normally, I'm not saying every time, but most often doesn't occur inside the incumbent because the tech debt, right? The amount invested in the current business is so big and you don't want to disrupt that by, inventing something new. So someone else comes along and does. We actually talked to a founder a couple of days ago that's working on uh, again, a differentiated way of processing tokens. I said the GPU was not invented to do what it does now. It was brute forced to do this, and it's good at it. It's not as bad at it, but it's not optimal. And so these guys are kind of going back to first principles and saying, well, what would I do? And their big thing is, part of the reason, like you said, that NVIDIA dominates is because they have this InfiniBand and the cabling but they also have CUDA, the software stack. And so they're coming at it from, well, we can build a different software stack that's modular. And I think it's an interesting approach. Now, maybe they'll be successful, maybe they won't, but I think it's an interesting approach that no way NVIDIA can fight because they're not going to modularize CUDA, right? They're just not going to do it.
Yeah, I agree entirely, and frankly, I think we've seen examples of this in the past. You could say the Windows x86 domination changed over time. You can point to historical examples, but what you're referencing on the GPU side, there are good potential of people who are building. I think NVIDIA is seen as sort of one horse for all horses, and that is going to change. And we talked briefly about Grok, but Grok is better at inference and scaling large inference loads than an NVIDIA chip is, and we're starting to see larger and larger acquisition of Grok infrastructure around the world that is more specialized and will outperform NVIDIA over time. The same thing is happening in the ASIC world. If you look at some of the announcements that Broadcom has made in the last few days, they are talking about next generation speeds closely associated with optical technologies that really, really open up the use of the ASIC and optical networking in AI workloads. And so, you will see wins there, and it's obvious that Broadcom and OpenAI are working closely, that Broadcom, OpenAI, and Oracle are working closely. So again, it's still, very early days, and a lot of moving parts. There's a lot of dynamic opportunity, if you really have your ear to the ground and are immersed in the industry to pick up these changes.
I was just going to say, we're rapidly approaching the hour mark, and there's never enough time, and there's so much to talk about. But, maybe on that early innings comment, well, let me put you on the spot here, and I think it's appropriate since we're in, the playoff season for Major League Baseball. But, kind of what inning do you think we're in terms of the AI opportunity? And, also on that, what's your prediction tonight for the score in the all-important Brewers Cubbies game?
Wow, a lot of baseball references there, but no, in terms of AI and its impact on society, I think we're, the top of the first. In terms of investing on the near term, we're far later in innings, of course. We are a big believer in, Gartner's sort of technology adoption, and Gartner's, there's also a hype cycle, inflated expectations lead to, eventual upsets. And then, there's a trough of disillusionment, which, we've tended to make a lot of money on because, again, we're focused on the signal, not the noise. But I would say, we absolutely have to be cautious on where we are on, top line valuations of many of the companies related to it. So, I'll say that we're in, the bottom of the fourth there, and cautious and looking for, big innings to either side.
But we need a middle reliever. We need that middle reliever to come in. And
that's right.
To stay on the baseball analogy, the time, there are times to be a fan of the major league and the big stars and the big sluggers and Mr. September, et cetera. But there's also a time to focus on next year and the minors, and you pull some players up, you put them on your roster at the end of the season and see if they're going to be the superstars of tomorrow. And those are the private markets. And I think we would probably agree, maybe even violently, that that's where the value, if you can call it that, is. One, because people just don't dive enough. Not that they don't dive out of neglect, but just not enough time to dive into the intricacies of new technology, like some of us, like yourself, has been there for 30, 40 years. So I do think it's actually a pretty good set of analogies for how we should be playing right now.
I agree entirely. I mean, that's why we keep, one foot in the private markets. I think there's some conflation out there of like really where the private markets are. I mean, you can invest very late stage, the OpenAIs, the Anthropics, these massive deals that, it's incredible how much money they're able to raise and incredible the appetite for it. So that's something to note. But where we focus is finding the names like Credo and IR Labs and Astera and others where they're still private and they're hitting, somewhere, let's say between, $300 million to $1 billion in valuation. Their technology's been proven, but now they're starting to hit commercial scale, and we can also help those companies out. And so, that's the classic venture capital model that Silicon Valley used to be, ratable venture round growth. And, if I'm a founder, I need to make it to the next semiconductor tape out. I know how much that costs. Unlike, sort of the last 10 years where venture capitalists were spending so much money on ride sharing or food delivery or anything. They were trying to create business plans out of just cash. They had to seed both sides of the market. We don't have to do that right now. And there are companies, and we've made a number of investments this year that are game-changing transformational technologies that people will wish they had invested in 2029 or 2030, just the same way that people in 2025 wish they had invested in Credo in 2020. So we absolutely wholeheartedly believe that, having a foot in the private world is where there really is really unique opportunities for a dedicated, immersed investor.
All right. Well, Will, so to tie a bow on it, do the and Mark, we'll let you close out with the lightning round. So, put Will on the spot real quick in terms of the series between the Brewers and the Cubbies. Do the Brewers get it done tonight? Or are we going back to Milwaukee? And then Mark, why don't you take us home with a quick lightning round?
The Brewers will heartbreak the city of Chicago tonight, and they'll have some time to rest.
as is loath to happen. It's next year. All right, so we'll do a super speed round. Will, what personality characteristic makes a great VC?
I would say inquisitiveness. Willing to really get in there and figure out what's going on with the company across different, from product to marketing to sales. It's inquisitiveness that really matters.
Love it. All right. Now, what personality characteristic makes a great tech CEO or founder?
A really strong aversion to or focus on signal versus noise. They know where their product is. They know where their market's going.
Yep.
They don't get distracted.
So, and we've talked a lot about this already, but what is it about AI that makes it for you the place to spend your career right now?
One, from a picks and shovel standpoint, there's still so much infrastructure to build, and we focus on infrastructure for our entire career.
Yep.
Two is just the unlimited opportunity. I mean, just as Uber wasn't created until multiple years after the iPhone came out. It was empowered by the iPhone.
Yep.
We are at the same level. Like, we have no idea what is going to happen over the next 3 years with AI. And you can get into those absolutely personal, corporate, whatever transformations. Those are still ahead of us.
No, it's great. It's Netflix before broadband, when you had to wait 4 days for a movie to download. Which, by the way, definitionally is not video on demand if I have to wait 4 days.
Yes.
Where do you look for inspiration on investment ideas?
I have a fundamental belief that investment ideas can come from anywhere. Within our team, the most junior analysts can come up with the most groundbreaking thing. Our COO and CFO, the same thing. You have to be really eyes wide open and look for where and be ready to associate. It's an association of data points and trends and themes that, taken in whole, is where the best ideas come from.
Perfect. All right. What do you read on a consistent basis that you couldn't live without?
The Economist.
All right. Nice. What do you do for fun?
I'm a very active racing sailor. It's the only thing I can do where I can actually get in a boat, leave the shores, and I forget about everything else for a little while.
Perfect. That's how I am on fly fishing, just blowing on the water.
That's great.
What's your favorite spot to eat back home in Milwaukee?
Oh, that's a great question. There's actually a lot of them. I would say Tops, the original hamburger place that was actually the original Arnold's in Happy Days. That'd be number one.
Yep. Awesome. Where do you escape when you need to get away and recharge the batteries other than the sailboat?
Getting away with my kids, and that can be sailing or anything. But there's as much of it. I have 3 boys. They're all under 12. They're a total headache, but it's also it's probably some of the best times of all of our lives. So
of course,
make the most of it.
All right, 2 more. So if you could have dinner with anyone, living or in the past, who would it be?
In technology, I'd say Steve Jobs. In everything else, I'd say Abraham Lincoln.
Oh, love. All right. The most impactful book you've ever read?
I think from an investing standpoint, Money Masters of Our Time, all those, Thane, Peltz books. I've been fortunate to work with many of the people that are covered there.
Yep.
I'd say impactful, this is totally off the run, but there's a book called Born to Win which is about the Australian campaign for the 1983 America's Cup, which, they finally broke the 150-year U.S. Stranglehold. So it's very much a David versus Goliath story with a lot of technology thrown in.
Yep. Perfect. Love it. All right. Corey, back to you for the last word. I'll just offer my thanks, Will, for doing this. So we could go a couple more hours. I'm sure everybody on the line would stay on and listen. But grateful for the relationship and for the opportunity to have the conversation.
Thank you, Mark.
Yeah, we'll leave it there. Will, thank you so much. This was fantastic. We'll have to run it back here soon, and it sounds like we'll have plenty of time to do so since we're so, still early innings in the great theme that is AI and everything you're doing within. So thank you for your time, and we will be back to listeners, hopefully with Will Graves again here soon.